Good afternoon, RGEA members and guests. Welcome to today's webinar, Proactive Tax Planning for 2025, presented by Kevin Cecil, Wealth Advisory for Cecil Financial. Taking a proactive approach as opposed to a reactive approach is always better, he says. Today, he will cover the ever-changing tax laws, RMDs, plan conversion benefits, family tax bracket management, charitable distributions, and more. I'm your host, Daryl Davis Fulmer, and today I also want to thank Tracy Eubanks for her technical support. Our primary presenter, Kevin Cecil, founded Cecil Financial in 2007 and serves as a wealth advisor. He earned his bachelor's degree from North Carolina State University and continued his education to obtain his certified financial planner designation. He believes that a holistic approach is best when addressing a client's financial portfolio. He provides personalized and professional services in the areas of insurance and investments, as well as estate, tax, and retirement planning. Cecil Financial seeks to build clients' confidence and helps them reach their goals. Kevin truly believes that planning for the future should feel productive and not challenging. Before we begin this webinar, I want to go over a few items. Each of you has been muted to help ensure the presenter can be heard. This presentation is being recorded. We will send you the link to the recording along with the PowerPoint and any other information in our follow-up email, including a survey. Those of you who sent questions, we submitted them to Kevin, and many are already incorporated in his presentation. If you think of a question during this presentation, please use the Q&A button at the bottom of the Zoom page, and they will be responded to as they come in or after the presentation. So without further ado, let's get started. Welcome, Kevin. We're looking forward to your presentation today.
Daryl, thank you. As Daryl said, yeah, we run a financial advisory practice here in Raleigh. And tax planning is one of the things that we really focus on. Much like all the uncertainty in the market right now, we're all invested, but we really can't control what goes on in the market, at least day to day. Whereas from tax planning, we look like we can actually get real savings, real control over that. So it's one of the things that we'd like to focus on, and we'd like to be proactive in planning. Let me see if I can. My screen changing. I think. Yeah, and that being said, tax planning throughout the year is something we proactively do throughout the year, so we can take advantage of different things. If we need to buy things, sell things, if we need to take deductions or look at it for the entire year versus just to clarify versus tax preparation, which we're all probably going through right now. But tax preparing is when you sit down with your CPA and you look backwards historically at what happened last year. There's not a lot you can do at this point. Maybe you can add to a traditional IRA or something, or a Roth IRA. But once the tax year comes and goes, really preparing your taxes is just kind of a historical look backwards. And kind of that being said, a lot of what we're going to do today is kind of keep it at a relatively high level, kind of keep it generic in nature, trying to talk a little bit to everybody. And I would say if something we go over or something sparks your interest, I would say, hey, grab that topic or grab that idea and take it back to your CPA, take it back to your tax advisor, and even take it back to your financial advisor. Say, hey, how does this affect me? Is there something I can take advantage of? Or is there something that I'm missing based on my specific situation? Because when we sit down with people, everybody's situation is just a little different. We'll talk about a couple different strategies, but when you talk about tax strategies, you have to be careful of a lot of different moving parts as it affects somewhere else. So with that being said, we'll kind of get into first really looking at trying to understand what tax bracket you're actually in. I think that's something good for everybody to know. Even if you're taking your information to a CPA, it's kind of good to know what bracket you're in general. And we're talking at the federal tax level. You can see we kind of break it down. We like to talk to people in really three main categories. If you're in the two lower brackets, you're at the 10 and 12% brackets. Those are really similar. And we don't mind paying a lot of taxes in those brackets because that's kind of as low as you can get it. On the other end, the highest tax bracket, we call that kind of our 32, 35, 37. That's like our tax sensitive. When you're in that bracket, you're really focusing on, hey, what can I do to lower my taxes? What can I do to save taxes today? And in that middle bracket, that's kind of where we like to calculate it. And I guess, yeah, when I say calculate it, what we're trying to do when we help people, it's looking at what do we pay today, what are we paying immediately, and then what are we going to pay over time? What are we going to pay in short-term taxes over the near-term future, over the next 3, 5, 7 years, and what are we going to pay long-term? What am I going to pay when I retire? What am I going to pay when I have to start taking my required distributions, which we'll speak on? Even long-term looking at in the family. Once my heirs inherit this money, what's their tax situation look like? Because several years ago, the Secure Act did a lot of changing, and from it increased the benefits of what you can save towards retirement, but it also kind of narrowed the focus when you inherit an IRA. You used to be able to stretch it over your lifetime. Now you get 10 years. So that kind of changed a lot of the different planning that we did from time to time. And let's look at the actual. Hopefully, you guys don't look at the tax brackets all that much, but it is good to know kind of what tax bracket everyone is in, what you're in. You can see if you're filing as a single, as you're filing as a head of household. If you're married filing jointly. Most people don't file married filing separately, but it is an option. One thing through the years we've seen with people that they don't quite understand. They think that this is more of a that the tax code, the tax rate that you pay is more of a cliff vesting. Like you can see as a single person, if you make over 48,476, that you get into the 22% bracket. Well, that's a marginal tax rate. That means that every new dollar that you make going into that bracket is taxed at 22. But that first 11,000 is taxed at the 10 still. That gap between 48,000 and the 11,900 is taxed at 12%. So it's an average tax rate. If you just make $50,000 as a single person on taxable income, you're not paying 22%. The last dollar you make is paying 22%, but the majority of your money is getting taxed at 10 and 12. So your average tax rate is probably much closer to like 12%. So understanding the bracket you're in and also understanding the difference in the marginal tax rate and the average tax rate that you're paying is kind of key in terms of planning and helping people just kind of understand their situation. Of course, everybody knows, well, I don't know if you can itemize your deductions or you can take the standard deduction. Now, several years back, the standard deduction doubled. So I guess technically it was in an effort to simplify people's taxes or at least preparing them. And it did do that. A lot of people with the state and local tax deductions being capped and with the standard deduction being doubled, a lot more people file with just a standard deduction these days. Married filing jointly is $30,000. And even if you're really charitably inclined, between interest on your home maybe and charitable deductions, it's really hard to get your annual giving over and above 30,000. Now, what this has done from a planning standpoint is we used to just pull forward as many deductions as we could every year to get a higher write-off. We would itemize, we would get the deduction, and that's what we did. Nowadays, we talk a little more with clients about bunching it because it's hard to get over, like if you're that $30,000 level. But can you double gift in one year? Can you give to the charities that you give to every year? Can you give in January? Can you give all of 2025's? And then in December, can you afford to give all of what you were going to give in 2026? And therefore, kind of you double what you give this year, which will possibly take you over the standard deduction. And then next year, you'll just take the standard deduction because your giving goes down to zero. So that's just bunching 2 or 3 years together is one of the things that we just kind of go over with clients on can you do it? And if you can do it, what's the way to plan for that? Here's my slide talking about that. So just kind of the new rule, we do a lot more timing and planning of what we give versus the old rule. We just deduct it as much as you can, get over the standard deduction, and that's it. Um, and kind of playing off of that, a really nice way. Now, a lot of these tax strategies we're going to go over, you actually have to have the money. So that is the key. We can talk a lot about strategies, but if you can't, if you don't have the cash flow to give a lot of money, they sound good, but they might not work for your situation. But we're using a lot more donor advised funds, which is kind of a super bunching strategy. You just basically grab a lump sum of money that you're going to give in charities over a 2, 3, 5 year period, if you can afford to, and you put it all in a donor advised fund in a taxable year. In that year, you get the entire write-off, but you can give that money out over time. So if you put $30,000 into a donor advised fund, you can give that money out over 1, 2, 5, 10 year period, but you get the write-off in the entire write-off in the year you put it in the fund. So that's pretty attractive from the standpoint of you fund a donor advised fund 1 year, and then through the years, you can just take your standard deductions through the years and go back and forth with that strategy. So it's just one more thing that we're doing a little more of with clients than we did several years ago when the code was changed. Now we talk about glancing at our long-term tax rates, long-term taxable gains for 2025. And a lot of times we talk about pulling forward and paying taxes in a lower bracket. These are some of the hurdles we really want to be careful of to make sure if we pull forward for one tax strategy, we don't mess up in a different tax strategy, because you can see the 0% tax rate for paying on a capital gains is really attractive. So if somebody's income, married filing jointly, if we can keep their taxable income below the 96,000, then any capital gains in that year, they don't pay taxes on. And of course, you can see for the same scenario, if you make over 600,000, then your capital gains rates goes from 0 to 15 to 20. So these are just kind of some thresholds to keep aware of when you're using a taxable account, whether it's stocks, whether it's selling different assets that you might have. How is this going to affect my overall tax rate? Can I make sure I pay 0 if I'm in that middle bracket? Can I keep it at 15 and not bump to the 20%? Now, a lot of times this is the comparison. A lot of times we used to just do tax planning at the end of the year. If you had capital losses, you would just take them. If you had capital gains, you would take them. But whether it's transparency or the ease of investing, and whether it's our new ETFs instead of mutual funds, different things, we talk a lot more about not just year-end tax planning, but throughout the year. Can we, with volatile markets like we're dealing with today, here, let's switch over. Can we take capital? Can we sell some stocks at a loss right now that we can build up assets at a capital loss that can offset capital gains? The market's been really nice. For the last couple of years, it's gone up for 20% last year and the year before. So we probably have some capital gains in our portfolios. Is there some things that have now turned into a capital loss this year that we can sell to kind of offset some capital gains? So we'd look at that a lot more ongoing throughout the year these days than we ever used to. Yes, you can still take a focus in October, November, December. What should I be doing for my overall capital gain budget? But it's nice to look at it throughout the year. And if you have a lot of capital losses, hopefully this year doesn't play out that way, but you'll see that in times where we've had bad markets. You'll have more than $3,000 in capital losses. Well, just note that you can only use $3,000 to offset your ordinary income each year, but you don't lose that. If you had $6,000 in capital losses, you can take 3 1 year, and just that other 3 just rolls over to the next year. So it's not lost. You just can't offset more than $3,000 in each year. And sometimes we even see trade-offs trying to take gains in certain stocks, certain assets. And this goes for stock investing. I keep talking about like the market, but I mean, this is houses. This is selling any type of asset that has grown in value. And we just try to figure out the difference between, is it good to sell it now versus continuing to defer that gain? And that's kind of how we help clients just work through when and how much to sell. I know a lot of people are retired, but if you're still working, or if you have a spouse that's working, or if you're working a part-time job, I saw some different questions earlier talking about I'm doing some part-time work. Let's just quickly look at some of the 2025 retirement plan contributions. And these are, you can see that the limits have gone up a little bit. They've gone up for the 401k, 403b. That's the 23,500 now. Contributions to a defined contribution plan, the max limit is 70,000. That comes into play if you have a profit. Some of you might have a profit sharing plan, SEP IRAs, different things like that. That's the maximum limit. Some smaller businesses have simples. Everybody, well, you can have a traditional or Roth IRA. Those limits are 7,000 this year. If you're over 50, you can see all the catch-up contributions and some of those changes to the Secure Act that we talked about a while back. I mean, in a couple slides, the government likes to keep us on our toes, and they now have this super catch-up provision that's for ages 60 to 63. And this is brand new. So a lot of this is kind of new to people. Instead of like a catch-up contribution in your 401k, used to be that 7,500. If you fit this 60 to 63, it's actually 11,500. So if you're still working or have access to a retirement 401k and you're 61 years old, you can end up deferring almost, well, yeah, 35, $34,000 into it. So if you're still working, a lot of room to be able to defer dollars for the future. In working with clients, we do a lot of planning, or we at least run numbers on, is it right to do a Roth conversion? They're pretty popular. And another provision that's gotten more and more popular because of the changes in the Secure Act from a couple of years ago, because like I told you, how it's not as attractive to inherit an IRA as it used to, because you used to be able to stretch that over your lifetime. Now we've got that 10-year rule. But even short term, some of the things we look at, what's good about a Roth IRA versus a traditional. And basically, a traditional IRA, 401k, 403b, all those pre-tax buckets that everybody's had through the years, that's what we're comparing them to. That was all pre-tax money. And when you get in retirement, start pulling that money out, that money is completely taxable. So if we're talking about, hey, I've got a pension and I'm taking Social Security, and I need a little extra money, if you're pulling it out of that IRA 401k bucket, that's where we start to bump up your tax bracket, where we were looking earlier, where you might go from that 10% bucket to the 12 or to the 22. So is there different advantages that we could do a conversion from that bucket into a Roth? What's the benefits of that? Well, that Roth is still tax-free compounding. A Roth, you don't have to take required distributions at age 73, which is pretty attractive. And whether it's you or your beneficiaries, you're going to be able to take that money out tax-free. So that's kind of nice. Now you got to jump to the hoops. You have to be over 59 and a half. You have to have the Roth for more than 5 years. But if you meet all the criteria, the Roth is tax-free going forward. Now, if you're talking about here, I've got another one that, yeah. How do we look at if we're talking about not only your lifetime, but over your lifetime and your beneficiary's lifetime, their brackets? We do a lot of what we like to call family tax bracket management. And this is just simply comparing the tax bracket you're in now, the marginal rate, and the marginal rate that let's say your kids are in. And if you're in a lower tax rate right now than your kids, it probably makes sense to go ahead and you pay a little bit of taxes now, and they're going to inherit something that they're going to be able to take. If they inherit a Roth, they can take it out at their higher tax bracket tax-free. So that's a nice play on not only your tax brackets, but also the entire family tax bracket. And windows of time where this is appropriate or at least attractive. And again, hey, we want you to make sure you've got the cash to pay the tax bill, because if you do a Roth conversion, we take money out of traditional IRA, that's going to be a taxable event in this year. We need to make sure what that taxable event approximately is going to be, and we'd like to know you have the cash in other accounts to pay that tax. And if you do, that starts to make the math better for getting it into the Roth. Windows of time where this is probably a good conversation with clients is from when you retire until the age 73 required distribution. Because a lot of times once clients hit their required distribution ages, they're bumping up into other tax brackets and it's not as attractive. But if you're retired, you got pension and Social Security, and you're in that 12% bracket, it might be worth a conversation to say, hey, let's do a mini Roth conversion of 10 or 20 grand each year to shift it into a Roth to save you money during your lifetime and definitely save money during your kid's lifetime. Um, Another attractive way for parents and grandparents to save for money is in college savings plans. It fits a lot of people's a way of giving to the next generation, but it kind of puts some you maybe you thought you find value in higher education. It's a way to get it in a tax advantaged vehicle to a goal that you would like to help assist with for younger kids once they get to college. Um, 529s used to kind of have a lot of restrictions around them, and the government's gotten a lot more open and a lot better about wanting people to be incentivized to put money in 529s. I think basically they're trying as good as the government can to address the student loan problems that a lot of kids are graduating. So they're trying to knock down any kind of hurdles that a 529 historically might have had. And they're really saying, parents, grandparents, can y'all save? One of the things that they came out with, they switched just this year or last year, was when grandparents save in a 529 and they take money out, that money is used to show up as income to the child and would hurt the financial aid calculations. Now it doesn't. So it's just a little bit better way, a little more incentive for that grandparent to save for a grandchild's education. One of the problems used to be, what if I end up with too much money in a 529? And they addressed that. They came out and they said, hey, up to $35,000, you can take a 529 plan and roll that into the beneficiary so that that child's or grandchild's, you can give it to them in the form of a Roth IRA over a 5-year window, 7,000 over 5 years. And that won't be a taxable event because a 529 is great. But if you pull it out for non-educational expenses, normally you're going to deal with a tax penalty, a penalty in taxes. They've cleaned that up a little. If up to 35,000, you can just move it over into that Roth IRA, and it's just one more way of trying to incentivize people to save. Talking about trying to save for or trying to gift or save for other generations is the annual exclusion amount. You can give $19,000 per currently for 2025. That's the maximum you can give from a tax exempt per person without having to file a gift tax return. So that's just a nice way if you're getting into gifting strategies. How much can I give? What types of places can I give? You can put it in that 529. So that's one area where you can gift it to. You can give it straight out. So there's a lot of different gifting strategies if that's something that you can afford to do and it's important to you. 2025 number is 19,000. Really quickly looking at wealth transfer. So if you really are wealthy, this number has gotten quite a bit larger. So we don't do as much estate planning for clients as we used to because just not as many people have estate planning. Now everybody has inherited income tax planning issues. Almost everybody needs to think about that. But the estate planning limits are up to 13 million for individuals. So do the math, roughly 27 million for married couples. So if you're not above 25 million, this is something we're really not talking a lot about. But this is the numbers, so everybody can see them if this is an issue for you. One thing, this does sunset back to $7 million approximately, where it was several years back at the end of this year. So a lot of the tax laws, and we'll touch base with this a minute, sunset, go back to where they were in 2016 at the end of this year. So January 1 of 2026 is everything sunsets. You're going to hear a lot about this through the years. I mean, through this year, because this is going to be a lot of noise in the news, a lot of people in Congress talking about what do we do with the sunset? Are we going to extend it? Are we going to change it? So this is something just to be aware of. if you're going through and you're trying to make various changes to either your estate plan or just your tax planning, just kind of keep an eye on what do they extend, what do they change rolling into next year. Um, that kind of rolls us into RMDs. So the government lets you defer all this money, which is nice. You do a 401k, you do a 403b through the years, which saves you tax dollars at that point. So everybody should be doing it. But the government kind of runs into, okay, now that you're retired, now that you're older, we want our money back. It used to be 70 and a half, but now it's moved to 73. And eventually in 2032, it'll be age 75 because basically we're all living longer. And all this is just rough math on how actuarial tables, how long the government thinks you're supposed to live. So if you're 73 years old, the government says, hey, you're projected to live 26 years and change. So their calculation forces you to take 1/26th of your money out of your IRAs and 401ks every year. So it's just a simple calculation we have to do. Sometimes people don't need the money, and that gets into more tax planning and different ways to get around it. But you're forced to take it. You have to take it, or there's relatively stiff penalties if you don't take out your required distribution. And it goes up every year. One way that has become more popular, a lot of good changes did come with the Secure Act. There's some issues, but some good changes. Is we're doing a lot more qualified charitable distributions. Now you'll hear these called QCDs. Our industry is awful about using acronyms, so hopefully I'm not using too many in this presentation. But what it allows you to do, and this is at 70 and a half, not technically till 73, your required distribution age, but anybody over 70 and a half can take money out of their IRA, send it straight to a charity, and it's not a taxable event. Because normally, if you take money out of an IRA, it's taxable. And if you want to give to charities, then you do that. And we talked about that itemized deduction. But with that double of the standard deduction, itemized deductions are harder to write off nowadays. The charitable giving is harder to get above the limits. So this is something that's really nice that you can give from your IRA directly to the charity. It doesn't come out as taxes to you. You don't have to worry about itemizing it. You just have to make sure your CPA knows, hey, I took 10,000 out of my IRA and gave it to a charity, because a lot of companies will just send you a generic 1099. They just know you took 10,000 out. You just need to be aware and tell the CPA, hey, I did this. Hey, I gave straight to a charity, so it's not a taxable event. And it does have a limit, but it's $108,000. So rarely does that limit bubble to the top of being an issue, but technically it's got a maximum of $108,000 in 2025. You can do this. As I was saying, roughly, well, not, I was looking at one of the questions. Tax law changes are on the way. We know they are. If Congress doesn't do anything, everything sunsets on January 1. So we know there's changes coming. What is going to change? What might be changing? Different tax rates are going to change. Your deductions may change. Corporate taxes had come down in that last major tax change. So does it go back up? Does it stay where it is? Different things we didn't talk about: qualified versus ordinary dividends. Qualified dividends are attractive if you have an investment account because they're taxed at 15%. They're taxed at the capital gains rates, whereas ordinary dividends are taxed at income. If you're in a 22% bracket, that's not as attractive. The estate planning, the estate tax level is probably going to be adjusted at some point. But that's currently not capturing a lot of people, or that's a relatively wealthy issue. But if it affects you, you should probably already be talking to your tax attorneys, adjusting documents. And the child tax credit is probably up for debate in terms of what gets adjusted with that. I think I was going to try to start looking through some of the questions to see, because that's kind of the majority of the presentation. We're here to help if anybody, but a lot of this is, hey, if you saw something on this, call your financial advisor, call your CPA and say, hey, how does this affect me? Should I be doing mini Roth conversions? Oh yeah, one of the things I know there was several questions on So IRMA, which is basically a penalty if you take out too much. If you bump into, I think this year's it's 106,000 for individuals, it's over 200,000 for married filing jointly. But if your taxable income is getting that high, then you're going to see an additional cost in your Medicare premiums. So you have to be careful of that. If you're doing what you don't want to do is do a Roth conversion because it helps you on one side, but all of a sudden you have to pay an extra $300 a month in Medicare premiums. And it might still help in the math, but that's something you need to be aware of before you just go and do it. Let me see, had questions on Social Security. If depending on what you make, sometimes your Social Security is taxed, sometimes it's not. I think the income limits, if you're below 25,000, a lot of your Social Security is not taxable. If you're married filing jointly and you're above 44,000, then 85% of it's taxable. So just being aware, if you're near some of those thresholds, just be careful planning. If you're doing any kind of conversions or pulling more taxable money into a certain year, make sure you don't hit a threshold. Some people may still be in the system with a Bailey qualified plan. Those are almost getting outdated, but that's a 401k through the state that's not getting state tax. That's still relatively attractive. That's nice. People talked about healthcare costs. Now, those are the ones unreimbursed healthcare costs. Once they get over 7.5% of your adjusted gross income, you can start to deduct those. So there were several questions around moving into a retirement community, assisted living, a lot of those types of scenarios. Just moving into a retirement community doesn't really trigger that. It's about the healthcare costs that you're receiving. That's what you need to add up. If that's over the 7.5, that's something that you're going to need to deduct if you can. Selling a house, capital gains on a house. If you're single, the first 250,000. If you're married, 500,000 is tax free. So anything above that, you'll pay capital gains on. I know there was a couple of questions on that. Trust. Now, there was a couple of questions on trust, but now there's so many different types of trust that it really matters. What are we doing an estate tax planning trust? Well, that's definitely driven by taxes. But you'll probably understand what you're doing. If you're just doing a living trust, a revocable trust that some people do, that's more for privacy. That's more for continuity. That's more for control for what happens. That's normally not any pro or con to a taxable event. That's almost like just one more taxable account that you have. So that's not driven as much by tax planning as it is by control and other issues. Several people asking about businesses. Business was probably a little too much out of the scope of just today's tax talk, but I would say quickly, if you're running a business, keep everything separate. Business income, business checking in one bracket, personal, keep everything separate, have separate credit cards, have separate expense accounts, because most of what you're spending, if you're a business owner, is probably deductible. So if you can keep it on one or two different credit cards, not commingled with your personal money, that's going to help. And then take it to your CPA and say, hey, here's everything I spent. What's taxable? Well, meals and entertainment has changed through the years, so it's not a straight deduction anymore. But a lot of your other expenses are. But then if you bought capital, you have to be careful. Is that a depreciable expense over time, or does it qualify? If I'm going to go get a large vehicle, what's the size of the vehicle that I need to get? And what do I need to deduct that? And how often do I need to deduct that? And then am I deducting mileage on my car or expenses on my car? So just keep track of all these things, take them to your CPA and understand what's fully deductible, what's depreciable, and what's, and what for one reason or another is just not a write-off. And then I know a lot of people that deduct part of their home, they work out of their house, so they deduct part of their home. Just be careful and take really good notes through the years. Keep track of that, because when you go to sell that house, that deduction is recaptured. It gets a little complicated. So if you are doing that, just kind of pay attention to how you're tracking that when you go to sell that house later. A business loan in and of itself is probably not going to show up and help your taxes, but the interest income is what's actually going to help you offset income. Basically there's I see some R&D on the math side of things. I had a screen up, but I don't know if I can get to it now that I'm sharing. But basically, you can Google and look at your deduction. So where it starts out around that first year is around 3.5, 3.6% of your IRA or 401k. I'm gonna call that one bucket. If you've got $100,000 and you're 73, you're probably gonna be forced to take out roughly $3,700 this year. It'll be a little more next year. It'll be a little more next year. It'll kind of go up through the years, but that's calculated each year. The value of your IRAs on December 31 of last year times this calculation of your life expectancy is how it's calculated, how much you have to take out each year. Maybe you can send it to a charity to save you taxes. If not, take it out. And then I was just trying to look at some of these IRAs and 401ks. I mean, that's a financial advisor question. A 401k definitely through the years is geared towards basically the questions, should I roll my 401k over? 401ks are great. When you start trying to take money out, I like moving it to an IRA. An IRA is geared towards taking deductions out a little more. 401k is a vehicle that's geared towards saving money. But if you're using someone like myself, for an IRA is probably going to cost you a little more fees. So just be aware of what you're going to be paying. But just really high level, an IRA is normally a little structured, a little nicer to take deductions, to do the charitable giving. It needs to probably be in the IRA instead of a 401k. And when you pass away, an IRA is a little easier to manage dealing with the beneficiaries. And an IRA and a 401k, both you're going to have to take the deduction. So, but if you have separate for now, really quickly, if you have a whole lot of IRAs, you can technically take your required distributions out of just one of them. You don't have to take 4% out of all of them. If 4% is your number, you can technically take 4% of your whole pie out of one if there's a specific reason to do that. But if you have a 401k, that has to be used separately. So sometimes just consolidating just makes it easy just to keep up with what do I have to do, asset allocation, all the other types of planning issues. It might make more sense to consolidate, but that's just something to think about.
Mhm.
A campaign promise last. Oh, I don't. Future tax changes. I apologize. We'd just be guessing at what they're going to do. I don't know if Social Security is going to be taxed. I don't know if tips are going to be taxed. It's just something to be aware of. If it happens, make the changes to your personal situation. Adjust. I do remember somebody in the questions. I can't see it now. Was working part time, and I think they were surprised at what they were paying in taxes. That's because everything you do builds on each other. So if you're taking a pension, if you're taking Social Security, and then you're doing part-time work, part of the problem is when you're in the payroll system of that part-time employer, that withholdings taxes looks at how much you're making. If you're making a couple $100 or a couple $1,000 a month, the withholdings table of the tax of the payroll software thinks, hey, you're only making 20, 30 grand a year. So they think you're in one of those lower brackets. So they're only withholding 10% federal. Well, what happens when you do your taxes between pension and Social Security and the part-time job, you're ending up in like the 22, 24% bracket. So when you do your taxes, all of a sudden, all that part-time income really should have been taxed at 24%, 22%. And you get this big tax surprise. And that's just a lot of times we just go in and we either do quarterly tax payments to adjust for that, or you just tell the payroll service, hey, I need you to withhold an extra couple $100. But that's just something that sometimes surprises people when they work a part-time job thinking, hey, I'm not making a lot of money. But in the eyes of the government, when you add it all up, you are in a relatively high tax bracket. So on QCDs, I tell people when you do the withdrawal, make the check straight to the charitable organization that you're giving it to. Now, a lot of times with my clients, whatever charity they want to give it to, I still send them the check and they hand it to the charity. They hand it to the finance person in charge just to kind of make sure it gets to the right place. But the check is made out to whatever organization, the Red Cross, and then they're handing it to the Red Cross. So don't put it in your it's you don't take the money out and then give it because then we got have to go through the itemized deduction straight from the IRA straight to the charity. Um, and most 401ks are not correct. So the QCDs can be given from a regular IRA, not from most 401k platforms are not geared towards doing the charitable giving. Inherited IRAs, you cannot do that also. That is true. Sorry, the difference between I think maybe you're hearing my so you have IRAs and you have Roth IRAs, and a lot of times I say doing mini Roth conversions because you don't want to convert. If you take your entire IRA or 401k and convert to a Roth, that's probably going to be a huge tax bill. So if I've got $200,000 in a traditional IRA, I say the term mini, that's more like an internal. We're doing a mini conversion of about 10 grand a year from your $200,000 IRA into your Roth IRA. We'll take 200 down to 190. We'll move to $10,000 over. The government's going to send you a 25, that's going to cost you $2,500 in taxes. So that's, I think when I said mini Roth IRA conversions, that's what it means. Just doing 10,000 a year for a 10-year window instead of $100,000 all at one time. So a
Kevin,
lot of
let me
times
help you.
when we're talking about do I take distributions from a Roth or distributions from a taxable account when I'm retired, that's where we kind of walk right up to the make sure I don't bump into IRMA because if I get into those IRMA limits, I'm going to pay more in Medicare. That's really frustrating because that is a cliff. If you go $1 over the IRMA limits, you pay that extra Medicare charge all year long. So be careful with those thresholds. And the Medicare the very first year too, it's kind of penal because it looks back 2 years ago's income. So you really got to be careful. Go to a Medicare specialist and see if there's a workaround for you individually. Because if you are a corporate executive making a bunch of money 2 years ago, your first year of Medicare premiums are going to be much higher than what you're probably living off of right now. See if there's a form, but it's not, you can't just say I'm retired now, lower my premiums. There's some check boxes that sometimes Medicare experts can help you work around. But as to where to pull money from, if you're bumping up on, if it's November and you're at the threshold of the 12% bracket, and you need a little more money to get through December, a lot of times we may look at a different bucket of money you have instead of pulling out $5,000 from your IRA and that being in the next tax bracket. We might pull it from your Roth. We might pull it from another investment account that's in a capital gains bucket instead of a tax bucket. So a lot of times we try to figure out which is better to pull from. Pension and Social Security are turned on. If I need more money, if I pull it from my taxable account, how much do I pay in taxes at marginal rate, or do I pull it from my Roth, or do I pull it from an investment account that I have? Just being mindful that Roth, if you can, Roth is the best one for everybody to inherit. Um, Basically 403 and not across the board, but 401ks, 403bs, I'm talking about them in general. They're taxed about the same. They are different. 403b was traditionally geared towards nonprofits. 401k was the private sector. Those have kind of you can see 401ks and nonprofits nowadays, but at this high level, we're treating them the same. If you're moving them to both going to an IRA, those limits that we showed with the 23,500, those are all the same. Um, so I didn't have a screen up showing. If you Google the RMD tables, it'll show you starting at 73, you have to take it. It basically says you're going to live for 27 years. So you take 1/27th of your RMD. What happens wherever your IRAs are, you will be notified, or you can do a calculation at wherever the money is. Our clients, I get a report basically several weeks into January saying, hey, Kevin Cecil, you had $100,000 on December 31 in your IRA. You're this age. You've got to take 4.1% out this calendar year. You got to take $4,100 out. So wherever your IRAs are, you can Google how much your RMD is going to be, but you'll be notified every January. You can do the math because you're looking at that December 1 value. Um, IRAs are permitted to do QCDs. Most, if not all, IRA platforms are going to be set up to do a qualified charitable distribution. So I would be careful of that. Can you contribute to a five? So you can gift dollars that will end up in a 529 educational savings account. Like if a parent, if my child has a 529 on my grandchild, and because this case it's a nephew, so if that parent, you can give money, you can give $5,000 at the end of the year to that parent and say, hey, I want this to go into a 529. Better, if you want to, you open up your own 529 for that nephew or grandchild as a beneficiary. A couple things, you control the asset, which sometimes is important to people. And also, it'll show up differently when they go to file for financial aid when they go to college, or even when they go to higher ed, private secondary schools, high school, middle school. So 529s are a lot more flexible than they used to be. A lot of people just like controlling it themselves. So you open the 529, you name the beneficiary, whether it's a nephew, grandchild, and then you can control it from there. And it's a little cleaner tax, and you can add to it through the years. Um, and just make sure you name successor beneficiaries. If something ever happens to you, who this goes to the parent of this child, or so just make sure you do your due diligence on who's inheriting that. Um, there's no the income restriction has gone away on the if you can do a Roth conversion. That was kind of in those early rules. I think the government likes you going ahead and the you front load your taxes when you do a Roth conversion. So I think sometimes if you're talking to a current somebody in Congress, they're like, yes, pay your taxes now. We appreciate it. I don't care about what happens in the future. So there's a lot less restrictions on doing a Roth conversion than there used to be. 457s, at least for this talk, are pretty much taxed and handled the same way. Um, that was the money that was deferred pre-tax. So now when you take it out, it's going to be taxable income. Now, some deferred comps are a little different. So sometimes you may handle those differently, especially if you retired before 59 and a half. You may leave a deferred comp in place and use that for your income. Because in general, just in general, if you go get IRA dollars or even Roth IRA dollars before 59 and a half, you're going to deal with a 10% penalty
Mhm.
on premature distribution. Normally, depending on where you worked in a 457, a salary deferral program like that probably gets you around that 10% penalty. So just be careful before you just start moving a 457 places. A lot of people keep that there and use it as part of their planning. But at a high level, it's pre-tax dollars being taxed when you pull it out. Um, Daryl, do you see any other questions that I like?
I wasn't, yes, the only one that let me pull it back up. And I just sent her a message. It was one that
Okay.
came in really early. Um, should I wait to invest in a Vanguard IRA? Did you answer that one? I just rolled over my 401 and am reluctant to put the check into the IRA right now.
Well, go ahead, definitely go ahead and put it in because some of those rollovers are timely. So you don't want that to, you want to go ahead and put that in. Now, I think if you're talking, and again, we'll keep this taxes, but if you're talking worried about the market, then just go put it in a money market. I mean, I would tell you not to time the market, but that's a whole nother hour discussion. But in terms of the check, just go to Vanguard, deposit that money, get it out of your hands, get it in the IRA so it's not a taxable event, and just have it in a cash account, in a money market account, in a short duration bond fund. I think that might be more generated from the markets are noisy, there's problems everywhere. I don't want to fully invest. So that's definitely a discussion. But I would put that money in the account. Don't necessarily invest the money if that's what the motivation for that question was. Um, I remember, yeah, I saw an HSA question. You can do an HSA. They're really attractive. HSAs are great because they're even better than like a Roth or an IRA because a traditional IRA is pre-tax, so you get the write-off, but you pay taxes later. A Roth IRA is after tax, so you don't get any benefit now, but it's tax-free later. The HSA is kind of the triple dip. It's pre-tax, so that's really attractive. It grows tax deferred, and as long as you pull it out for qualified healthcare expenses now or in retirement, it comes out tax-free. So if you got access to an HSA, do that. Do that to the max if you can. But I remember the question, but if you're doing an HSA, once you hit Medicare, once you hit 65, you can't do it anymore. Now you can still have the HSA, so that HSA can still be used to pay Medicare premiums. It can still be used for all those medical costs that it was intended for. So yeah, so that's one of the ones I don't have a slide on HSAs, but if you have an HSA, definitely definitely do it. Money market accounts favorite. Money market accounts are just safe. That's just like a safe. And again, there's different types of money markets. So I'm keeping it a high level, but money market CD, that's just kind of my safe answer for if somebody's really scared. Money markets from all the low interest rate environment, we quit doing money markets across the board. Rates were at zero. Safe money was at 0, 1, 2. If you went to a bank, your interest rate on checking and savings had a zero in front of it. Even though 2022 was painful, we now have really attractive rates on attractive as a relative term, but money markets are paying 2 and 3. CDs are paying 3, 4, 5. So it's safer money has more incentive to be saved nowadays, at least than it did from like '09 to 2021. So if you're scared, if you're squirrely about the markets, at least get it in, put it in a short-term bond fund, make 4%, and just talk to your advisor about what should I be doing how should I be fully invested? And then just get over your emotions and just kind of work on a plan, whether it's 6 months, a year, 2 years to get those fully invested. But money markets and CDs are a lot favorable than they were 5 years ago when they basically didn't do anything. I don't think you can do directly to a charity from a 403B. Call the 403B company, ask them if they're equipped to make direct investments to a charity. The last client I talked to last week was not, so we're moving. They have a little nuance about their 403B to keep part of it there. So we're moving half over, and that's where we're going to do the charitable distributions for their benefit from that. But we still have to be mindful that the 403B portion is still going to have to take the tax out. So, but at least part of their charitable giving, we're going to be giving through the IRA. Yeah, I mean, the savings accounts to a money market, just look at the restrictions. Those are probably easy transitions. I bet your bank is paying you 1 on a savings and 3 on a money market. I would do that but ask for the fine print. If you have an Old Bailey plan, I don't know if those are old. Those are from like the 80s. Some people still have them. If you have a Bailey qualified retirement plan, distributions in North Carolina, you don't pay roughly state tax is around 4%, 4.5. You don't pay that tax on your distributions. So it's not a big deal. Federal, you're paying 22, state, you're paying 4, but it's something to be aware of. So if you have an Old Bailey plan, you're probably not paying, whether it's 401k, 457, you're probably not paying state tax on that distribution. And if there's some different charitable annuity strategies we have for moderately wealthy and up, where you give larger chunks of money, and probably an annuity structure that gives charity money now and benefits your heirs later, or the opposite, gives you money now, but you get a deduction and the charity gets money at your passing. So if you're in that level, you're probably definitely working on some of those strategies. That's probably a little high level for this talk, but hey, I've got an estate tax problem or an income tax problem. I've got an asset I'm not using. Should I give it to a charity now? Make sure you have that discussion with your CPA, your tax attorney, and your financial advisor, because there's probably, depending on which strategy, it's complicated, but the math normally works if you've got that asset to give away.
Kevin, This has been great. I think that might be it
Oh,
for
there's
question,
my
but
buzzer.
I have one if you don't mind.
If I can
If
answer it.
people have, I can take that mic privilege, I guess. If people have investments right now, should they just let them sit?
Everybody's
Or,
different. The easy answer is yes. What you hate to see if this is a normal correction, like we did, I try to remind people there's a 10% correction on average, and the world doesn't live in averages, but it does. There's a 10% pullback in the market on average every 18 months. Is that what we're dealing with right now? And if so, normally, after that 10% correction, the market rebounds double digits in the next 3 to 6 months. So the long-term average says try to hold on. And if you're able to buy through it. The market, the NASDAQ is down 10, 12%. I don't know about today. So in theory, if you liked tech stocks 2 months ago, you can buy them for 10% cheaper now. Now, that's the hardest thing in the world to do because it feels scary out there. The market does not like
Mhm.
uncertainty. So the buy low, sell high is probably the toughest thing an investor does. I would try to not have somebody sell today based on it's already down 10. Now that person will call me back when it goes down 20. And that does happen. We have those corrections are more like correction is 10% down. Those are once every 18 months. Recessions and 20% pullbacks are surprisingly once every 3 to 5 years. So, they're
Right.
normal. Nobody remembers June to August of last year, but basically we had this exact same pullback June to August of last year. We had an election year, inflation was
Mhm.
higher, lots of unknowns. The market pulled back roughly 8 to 9%, not quite the 10, and then it went to rip and make 10, 15% higher. Nobody remembers that. So what I'd love to tell you is nobody's going to remember this month come October. But when you're in the middle of it, man, it can pull at your emotions. Um,
Yeah.
so tell people to structure your portfolios. Last thing I'll say, have a bucket of safe money, that bond, that money market, that CD. Have 3 years of savings or expenses that you spend. If you spend 20 grand a year, have 60 grand. If you spend 50 grand a year, have 150 grand sitting in safe CDs, bonds, trying to make 4%, and let the rest invest. And that'll get you through these times when, if you need money, just go grab the safe bucket and let the other stuff dip and then go back up.
Hmm.
But it's
Okay.
hard.
Well,
It's hard. Don't
it
watch
is.
the news. It's hard.
It's just very hard. But thank you, Kevin. This has been most enlightening. I learned a few things myself, and I'm sure the audience did as well. I have just a couple of items before we close up today, but Kevin, thank you. Thank you. Thank you so very much. And thank you for doing this for us on such short notice. So I have a few things I need to remind the audience. Don't forget to complete the survey we'll be sending you later this week. And again, it's quick and easy to complete, and we'd like to have our responses back by Monday. So before we leave, note the next Lunch and Learn webinar will be Wednesday, April 20, no, Wednesday, March, I'm already in April. Wednesday, March 19th at 12:30, entitled Caregiving is a Journey: Innovative Resources and Support for North Carolina Caregivers, presented by Lindsay Goldman from Alzheimer's Association, and Noah Shaw. He's the founder of Care Yaya. So please plan to attend. I just talked with them this morning. It's going to be an excellent session. And if you're struggling with caregiving or know that you might need to assist with caregiving or need caregiving, you should attend this webinar next week, March 19th, Wednesday at 12:30. We continue to strive to ensure that you are getting the most out of your membership and benefits at RGEA. And we thank you once again for joining us. And as always, this association stands ready to assist you in your retirement. Happy Wednesday, everyone, and stay safe. Thank you again for coming. Bye bye.